Let us get into accounting standard 22, that is accounting for taxes on income, which is like basically which deals with the provision for taxation, that is nothing but current tax, at the same time deferred tax. See here, when you see profit and loss statement, you will find very clearly there is a expense, tax expenditure you will find. In the tax expenditure, there will be two things. A is current tax and second one is deferred tax. What is current tax? Current tax is nothing but what you are supposed to pay as per the Income Tax Act. Correct. That is nothing but provision for a tax. That is called current tax. And the second thing is deferred tax. What is deferred tax? Deferred tax is something arises because of this standard which will be recognized actually. So let's get into one by one. Okay. So as I explained, current tax and deferred tax, this slide is over. Correct. So why this deferred tax comes in? Deferred tax comes in because of the timing differences. What is the timing difference here? Yeah, some expenditure which will be booked in the profit and loss in the current year, but that may not be allowed to be booked in the same year. That may be already booked as per the Income Tax Act, or it may be booked at the later point of time. So recognition of some expenditure, recognition of an income may be at two different timings, as per the books of account, that is as per the accounting standards or Indian GAAP, and as per the Income Tax Act. So end of the day, this is going to be incurred to ensure the matching concept of tax expenditure. What is matching concept? If you recognize a profit of say 100 rupees, if the tax rate is equal to 30%, then 30% of tax is supposed to be booked. This tax expense, when I say, that includes current tax, that includes deferred tax. Correct. So to ensure the matching concept, this standard has come. So what is the timing difference? Timing difference is nothing but, yes, difference is coming in one particular year and which is capable of being adjusted or which is capable of being reversed in the one or more future years. Then it is called a timing difference. We will recognize a deferred tax asset or liability. I mean basically deferred tax income or expenditure. Okay, only for the timing differences. What is a permanent difference? Permanent difference is something, difference is coming in one particular year and which will never be capable of being reversed. Okay, so since it is never going to be reversed by the income tax, correct? Then what is the point of recognizing? What is the point of recognizing the deferred tax? Yeah, say example, expenses disallowed, permanently disallowed expenditure, something like penalty, something, correct. So those things, once it is disallowed, that's all. It will never be, it's not like it is disallowed in one particular year, it will be allowed in the later year. No, it is not like that. So under that circumstance, there is no point in recognizing the deferred tax asset or deferred tax liability. I hope you understood. Okay, so for permanent differences, we do not recognize any deferred tax asset or deferred tax liability. Yes, that is what recognition I have told. Deferred tax will be recognized for all the timing differences, but not for the permanent differences. Correct? Now, there is no point. And deferred tax will be deferred tax asset means asset is debited, means deferred tax income will be credited. Deferred tax liability is credited, then deferred tax expenditure will be debited. Okay, yes, deferred tax asset. So do you recognize deferred tax asset for all the timing differences? Yes, you recognize it, but there is a small condition. See, whenever you recognize an asset, then there is a basic conditions to the asset. What is that? There should be probable future economic benefits in flow. So here also what the standard is asking, is there a reasonable certainty that I am going to utilize this asset to offset my future liability? If you say yes, correct, reasonable certainty they are asking. Reasonable certainty is just arises from the projections, arises from the expectations, correct, now forecasting, yes, budgets, then it is fine. If you say that I am going to get a future profit, then taxable profit, then there is no problem to recognize it. Okay, right. At the same time, but deferred tax asset should not be created on the unabsorbed depreciation and on the carry forward losses unless until if there is a virtual certainty supported by convincing evidence. So what is that? So right, this is unabsorbed losses. So when there is an unabsorbed losses or business losses, what does it mean? That gives a clear indication that the company is not making profits. Correct. Now, so when company has made losses in the current year, what is the guarantee that you are going to make a profit in the future? And whatever this loss, correct, unless until you get a profit in the future, otherwise this business losses cannot be offset in the future. So what is the certainty? Simply because you have a loss in the current year, I shouldn't create the deferred tax asset unless until there is a virtual certainty. When you say virtual certainty, it's not an estimation, it is a matter of fact. So if the company is able to prove that there is going to a profit because of we entered in the agreement where our sales are going to be improved, that's why I'm going to get a taxable profit in the future, unless until if the client or if the accountant, the company is able to prove otherwise, you're not supposed to create deferred tax asset on these unabsorbed depreciation and business losses. Correct. Deferred tax liability, it's a liability. Liability means liability account credited, expenditure is going to be debited. So here there is no restrictions as such. At the same time, reassessment of deferred tax asset and reassessment of deferred tax liability, both are supposed to be reassessed at the end of every year end. You are supposed to look at. Say example, you had unabsorbed business or business losses in the last year. Correct. Now last year you did not create deferred tax asset because there was no virtual certainty. Correct. Now maybe in the next year you got a virtual certainty. Now your business picked up. You started making good amount of profits. Correct. If you are able to show me that virtual certainty in the next year, in the that year you can recognize the deferred tax asset. It is not that in which year you made the loss, that year only, that time only you should recognize, otherwise it is lapsed. Nothing like that. Because as you know, business losses can be carried forward for 8 years. Unabsorbed depreciation can be carried forward for a lifetime. Correct. So it should be revised, it should be reassessed, you should relook at it. Right, if it is not recognized DTA earlier, now can you recognize? If it can be recognized as per the standard, you please recognize it. Or sir, earlier recognized this much, now I want to recognize more. Yes, relook at it, reassessment should be taking place. Next, sir, which rate deferred tax asset or deferred tax liability is supposed to be done? You should apply the whatever the applicable tax rate which are enacted. Correct. So no sir, some are there like which are substantially enacted. So generally we don't use the substantially enacted, but the sentence though is there in the standard. International standard also says that enacted and substantially enacted rate should be taken, but practically we apply those enacted rates only. And the next one more new concept, that is tax holiday due to 80IA, IB, 10A, 10B, whatever is for the correct tax holiday. What is tax holiday? During this period of time, the company does not need to make any tax. Correct. Even though they get X number of profit, still it doesn't need to make a payment. That means current tax is going to be zero in the respective year. Correct. So what should I do? It is very simple. During the tax, right, point is very simple with respect to deferred taxation. Deferred tax, what did I say? Right, difference is arising in the current year, which is expected to be, it is capable of being reversed in the future years. Point number here, correct. If the difference is arising in the timing difference is arising in the tax holiday period, and which is capable of being reversed also in the tax holiday period. Correct. Then no deferred tax asset or no deferred tax liability should be created on those timing differences. But ulta, what is ulta? Timing difference is arising in the tax holiday period, but it is expected to be reversed after tax holiday period. For those timing difference which are arising in this tax holiday period, yes, which are expected to be reversed after tax holiday period, yes, you have to create deferred tax asset or deferred tax liability accordingly, subject to just now discussion whatever we have made. Right. And one more information, like minimum alternative tax. Yes, number of times this question has been asked. Number of times this question has been asked in the examination. What is minimum alternative tax? Yes, if under some circumstances of 115 JB, the company is supposed to pay a special rate. You have to pay not 25%, not 22%, not 32%. A special rate of tax is supposed to be applicable, subject to certain conditions. Under that circumstance, your income tax, taxable income will not be computed. Your taxable income will not be computed like what you do under section 28. Okay, so what is that you will do? Under MAT, you are supposed to calculate book profit. How do you calculate book profit? You will take the profit before taxation, and you will do plus or minus few adjustments which are set by the section, and on that profit, a special rate of tax is supposed to be applicable. Okay, now the question is, sir, when I am making the deferred tax, should I use the MAT rate or should I use the normal rate? Standard says normal rate only is supposed to be applicable. Why? because current year MAT is applicable when the timing difference is going to be reversed. God knows whether you will be falling under 115 JB or you will be falling under the normal rate. Okay, right. And for this, generally, sir, how do you create this? See, simple thing. First you should calculate what you should calculate. You should calculate the current tax applying the normal rate. Applying the normal rate and considering that just for understanding purpose. End of the day, the current tax will come back to MAT rate. Nothing to worry. Just to calculate the exact deferred tax. First apply the normal rate of current tax. Then what would have been the deferred tax considering that circumstance? Calculate and keep it aside. Then you compute your MAT rate. What as per the MAT rate on the book profit into MAT rate you apply. That is going to be the current tax, not first one what you have calculated. Because that is only I told you just to get the till you get the deferred tax, that is going to be useful. And the last slide with respect to the standard is presentation disclosure. Suppose you have got a deferred tax asset, correct na, and you have got deferred tax liability. The question is whether these two are correct na, can you offset? Correct na, can you offset? You can offset if both the things are arising from the same act. Okay, I mean, sir, both the things are coming from same income tax act only. Anyhow, in India, we have only one tax act. So, if it is arising from one income tax act, you will be able to offset deferred tax asset with deferred tax liability. Now, sometimes what happens? Suppose your subsidiary, correct? Now, subsidiary may be having deferred tax asset and the deferred tax liability in the holding company books, correct na? But when you are preparing the consolidated financial statements, you should not offset. The company balance sheet will be having deferred tax asset as well as deferred tax liability. Both the things will be presented in the balance sheet. Okay, right. At the same time, when my subsidiary is outside India, then that tax is computed as per that country's laws and regulations. Correct na? That time also, if while consolidating, still you are not supposed to offset. You are supposed to present it deferred tax asset, deferred tax liability separately. Correct? You should not offset. This is about accounting standard 20. Let's get into now accounting standard 21, consolidated financial statement. This standard is obviously, as you know, it's a little big standard. It will take considerable amount of time, not little time. Right, consolidation. Why are you supposed to do consolidation? Yes, and who should do it? As per section 129 subsection 3 of the Companies Act, every holding company, every parent company, whoever has got a subsidiary, or even if it has an associate, it is supposed to prepare the consolidated financial statements and it should be approved by the board of directors and it should be given to the AGM as well. This is mandatory section. Yes, it should be done. Okay, right now what we are talking under accounting standard 21 is consolidation, that is line by line consolidation. Consolidation of the parent and subsidiary companies, consolidation of the associate company, consolidation of the joint venture company, that will be done by accounting standard 23, accounting standard 27. Next, what do you mean by subsidiary? Subsidiary is a company or any entity where our company has got a control. What do you mean by control? Control means where we have got more than 50% of voting rights, okay, in the other company, or where you have got the control of the board of directors composition. I mean to say, without our permission, you cannot remove a board of director or you cannot add another board of director. Then you can say the other company is our subsidiary company. Okay, under these few circumstances, you don't need to consolidate. You don't need to consolidate as per the standard, and there is one more clause as per the MCA notification. When you don't need to consolidate, when it is a temporary, investment is in temporary nature. We purchased it today. Maybe today you have got like 51%, but my intention is not to control the company, not to get into their financing activities or operations. No, I don't want to control their financing and operating activities. As part of my investment, suddenly it went up to that percentage, and tomorrow once I get the good price, I'll sell it off. So under that circumstance, you don't need to consolidate. And the second reason is where the subsidiary is operating in severe long-term restrictions. I say your subsidiary is in Pakistan or China, and they have that country has kept in long-term restriction, like you should not transfer 1 rupee also to India. Then you should not consolidate. Sir, if I don't consolidate, what should I do? You will show you. Then see, under these two circumstances, if you are not consolidating, okay, then you are supposed to show under I mean under accounting standard 13 as a non-current investment. That's all. Non-current investment will be held at cost as per the respective 13. Okay, right. Under this following circumstances, this is as per the MCA rule as I was telling. Correct now. Right. This rule is applicable. I mean, under these circumstances, you don't need to consolidate. When first thing, see, it is a situation like where I am the holding company. I have got one more parent company below a subsidiary company. So I am also supposed to prepare consolidated financial statement. My parent company also should prepare consolidated financial statements. I am telling you, for the top company, there is no exemption. You have to prepare mandatorily consolidated financial statements. And the middle company, what am I supposed to do? The middle company, you don't need to prepare. Got my point? You don't need to prepare when you are not a listed company, or when you are not in the process of listing. Also, at the same time, second one, ultimate parent company, immediate my parent company, I mean above me, whoever is there, if somebody should be preparing the consolidated financial statement, and that consolidated financial statements must be made available to the public. That is the situation. At the same time, correct now, right? This I should, when I am not preparing the consolidated financial statements, I should be speaking to my shareholders. Correct now, I should get permission from them. Nobody should object. Nobody should object that I am not going to prepare consolidated financial statement. If there is no objection, and the other two conditions of, I mean, what is that? It is not listed now in the process of listing, and my parent company is consolidating me and my below subsidiary. Correct now? Then you don't need to prepare any consolidated financial statement. Otherwise, you are supposed to prepare it. See, this is first topic number one. I will say basic consolidation. Second topic, I mean, this is balance sheet consolidation. What I am talking. Topic number two is nothing but P&L consolidation. Okay. In this basic consolidation, what are the important points? One is line by line consolidation. That means line by line in the sense all assets, liabilities, income, expenses, parent company plus subsidiary company, that is equal to CFS. Like that we will take it. But yes, there will be some adjustments. Next, step number two or something like in elimination of the carrying amount. Correct now. So in the parent company standalone books, you will be finding investment in subsidiary. That number you should eliminate. Why are you eliminating? Because of this investment only entire assets and liabilities, income, expenditure are coming to your financial statement. That's why you have to eliminate the investment in the parent company, and you are supposed to compute the goodwill or capital reserve on the date of acquisition. Computation of goodwill, computation of capital reserve should be taking place as on the date of acquisition, not as on the date of balance sheet. Correct now. And whatever the subsidiary profits as on 31st March, that is supposed to be bifurcated between, correct now, pre-acquisition profits, post-acquisition profits. I mean, what is pre-acquisition profits? Whatever the profits earned by the subsidiary before the date of acquisition. Post-acquisition means whatever the profits earned by the subsidiary after the date of acquisition by our parent company. And you are supposed to determine what is minority interest. We'll discuss a little bit about it. And this next important point, elimination of, correct now, after this consolidation, elimination of intercompany, this intra-group assets, liabilities, income, expenditure, you are supposed to eliminate because you have clubbed it. Correct now. I mean, it may be receivable for the holding company, it may be payable for the subsidiary company. You have to knock off both the things. And unrealized profits, unrealized losses on sale of goods, or sale of fixed assets are also supposed to be eliminated. That is how this consolidation will continue. Let's look at each one. See, generally I teach in the classroom like there will be 6 steps. Step number 1, that is the basic information you have to identify. Correct now from the question. First one is what? Date of DOA, DOB, DOC. DOA is date of acquisition. Why? This is very important. If you don't make it, then there will be a problem. Correct? Is it happening at the end of the year or is it happening middle of the year? Correct now. How many months before? How many months later? This is all the information required. DOB stands for date of balance sheet. DOC stands for degree of control. Here generally I'll ask the students to write how much percentage is held by the parent company, then automatically remaining percentage is held by the minority people. So minority interest also will identify. Step number 2 is very crucial. Correct. Now this is analysis of the net assets. Correct. Now analysis of net assets I will say. What is net asset? Net asset is nothing but equity of the subsidiary. So what do you do here? I'll have some 4 columns. Particulars, balance as on date of acquisition, balance as on balance sheet date, and the post acquisition profits. Correct. Now net assets means I told you equity. Equity includes what? Equity share capital plus reserves and surplus. Which reserves? Every reserve. Correct. That is a general reserve, retained earnings, a revaluation reserve, capital redemption reserve, any reserve you call, no, all the reserves and surplus will be coming into the picture. Now, here what are you supposed to do? How do you fill this information? Share capital as on the date of while purchasing the data, when you are acquiring the control, no, that date how much was there, and as on today how much is there. Correct. If there is something is there that is subsequently issued, correct na? In the same fashion, general reserve, security premium, retained earnings, correct na? Same thing, as on date how much, today how much is there. So example, today example is retained earnings. Retained earnings nothing but surplus. Correct na? Surplus, that is the accumulated profits you can call. So sir, as on the date of acquisition it was 100. Today it is 130. So 30 is acquired, 30 is earned after the date of acquisition. That is nothing but post acquisition. So now, okay, whatever some answer will come, what should I do? Till the date of acquisition net assets, that should be utilized in step number 3 for calculation of goodwill or capital reserve. At the same time, step number, correct na? At the same time, so do I take entirely? No, you cannot take entirely out of, say example, column number 2 total is equal to 100 rupees and parent company is holding 80% of it. 80% will be taken for step number 3 and 20% minority portion will be taken for step number 4. Same fashion, post acquisition profits also, correct. Now if you get say 200 rupees of post acquisition profit has come, out of 200 rupees 80% will be taken by the subsidiary company, that is step number 5 I will take it, and 20% I will be taking as a minority interest under step number 4. Okay, right, this is the same information, step number 2, 3, 4 ka information. Step number 3, what do you do sir? Calculation of goodwill or capital reserve. So first thing, what is the cost of investment? How much you have invested and how much have you paid? Maybe by issue of equity shares or maybe by issue of giving cash or whatever it is. That is the total consideration you have given to acquire the control minus proportionate share of the net assets on the date of acquisition which are taken, correct na? Which on the date of acquisition, that only you are supposed to take it. You should not take everything. I hope you got it. Correct na? Yes. So this is coming from step 2, column number 2. Then the net number will be, the difference number will be either goodwill or capital reserve. Okay, right. Step number 4, minority interest calculation. Minority interest, as on today, whatever is there, that correct, the total net assets of the subsidiary, that 20% of the subsidiary should be going to minority interest. Exactly. So that's why what do you do? Correct. It is as on the date of acquisition, net assets as on the date of acquisition into percentage of minority, post acquisition profits also into percentage of minority you should apply. That total is nothing but minority interest as on the balance sheet date. Where do you present the minority interest? Minority interest will be presented after reserves and surplus and just before the long term liabilities, non-current liability, before non-current liability, after reserves and surplus we present it. And step number 5, this is the group reserves and surplus, group retained earnings, a group reserves and surplus I would like to say. What do I say? I'll keep some few many columns like retained earnings, one separate column, security premium, revaluation reserve, general reserve, every reserve will keep it. First line will write what is the balance as per the balance of the parent company, I will take it. Then what do you do next? Plus share in the post acquisition profits. Correct, because post acquisition profits of the subsidiary, our share, our 80% I would have taken, I will add it. Plus or minus some adjustments will be there, which we will discuss in few minutes. Then the net number, whatever comes in, that should go to consolidated balance sheet under the reserves and surplus, that total should go. And this is what my consolidated balance sheet, correct, consolidated balance sheet. Non-current assets, yes, we will take parent company, subsidiary company. Current assets will take parent company, subsidiary company. Investment in subsidiary, elimination we told, that's why it will not be there. Goodwill, if it is arising, then under step number 3, that number will come here. Share capital, yes, parent company share capital will come. Reserves and surplus will come from the step number 5, just now we spoke. Capital reserve, if it is arising on acquisition, step number 3 computation, it will come under reserves and surplus. Minority interest, step number 4 number will come. Non-current liability, parent and subsidiary plus, and current liability also parent and subsidiary company plus will come. Right, minority interest as I have discussed, correct na? Right, minority interest will be showed separately after the reserves and surplus and before the non-current liabilities. But one point, important point, minority interest should never be negative number. That means a minor, suppose the subsidiary is making continuously losses. Yes, minority interest number should become 0 maximum. It cannot be It cannot be negative unless until the minority shareholders are liable to pay you as per any special agreement or as per the law. Okay, otherwise minority interest should be zero. And sir, if it is zero, sir, they are supposed to actually there is a minus of 200 rupees, right? And it cannot be minus 200. That minus 200 should be borne by the parent company. Should be borne by the parent company as per accounting standard 21. Okay, revaluation of assets. Sir, what is this revaluation of assets? As on the date of acquisition, okay, when you are purchasing the subsidiary, you must have revalued the asset. But even though we have revalued the asset, that is for the payment of consideration, you have revalued the assets. But actually, this is not a revaluation as per accounting standard 10 by the subsidiary company. Hence, subsidiary company has not recorded any revaluation journal entry in their standalone books of account. But whenever you are considering for your whenever you are considering for the consolidation purpose, you are supposed to revalue the assets. Correct? Revaluation may be plus or revaluation may be minus. Correct? So since you are revaluing for the purpose of this, correct, under step number 2, revaluation reserve as on the date of balance, date of acquisition, whatever the plus or minus number should come. Correct. Suppose one asset is increased, so you will be taking, correct, I mean you are incorporating such revaluation in the standalone financial statements only for the purpose of consolidation. Actually, entry is not recorded by the subsidiary company. Since the asset has gone up, then are you going to get the additional depreciation? Yes. Depreciation additional will be charged only post acquisition. Correct. So additional depreciation is supposed to be charged and should be reduced from the post acquisition profits. Okay, in the same fashion, if it is reduced also, then depreciation is supposed to be reduced. Like that, you are supposed to take care with respect to revaluation assets. So on the balance sheet, when you are preparing the consolidated balance sheet, so what is the revalued amount plus what is the subsequent after date of acquisition, whatever is the additional depreciation, normal depreciation, you have to reduce it. That number only will appear in the consolidated balance sheet. Okay, right. Dividend received from the subsidiary company. As you know, accounting standard 13, as we have discussed sometime before, correct? Now, income will be divided. Dividend income will be divided into two parts: pre-acquisition income, post-acquisition income. If it is a pre-acquisition income, it should be reduced from the cost of investment. That's what cash account debit to investment account. Correct. If it is a post-acquisition income, it will be transferred to profit and loss statement. Same thing. Correct. Now, whenever you read a question like income, dividend income is received from the subsidiary company, then correct accounting should be taken care in the account in the holding company financial statements. Correct. It may be adjusted with the investment account or it may be transferred to P&L. That should be taken care. Okay, done. Next, treatment of subsidiary which is having preference share capital. Correct. Preference share, whenever there is a preference share capital, first question should come to your mind: is it cumulative preference share capital or non-cumulative preference share capital? If it is a cumulative preference share capital, you are supposed to make a provision for payment of dividend, because in case of cumulative preference share, and if you have got, obviously you will make a provision for only when you get a profit, not when if there is sir, my subsidiary is making losses, then this concept will not come. Correct. Now, you should make the subsidiary is getting the profits and there is cumulative preference share capital. You should provide for the dividend whether or not it is declared. If it is a non-cumulative, then it should be made a provision only when it is declared by the subsidiary company. Otherwise, it should not be taken into account. Okay, right. Next, we are reaching to one more level, that is intra-group transactions. Intra-group balances, intra-group transaction. In the profit and loss statement, transactions will be eliminated. In this one balance sheet, you will be eliminating the intra-group balances. Correct. Now, current account, that is receivables, payable. Correct. Related to current account. Yes, in the parent books, it may be receivable. In the subsidiary book, it is a payable. Whatever you are going to, after preparing the consolidated financial statements, you should knock off from this side and that side. You should knock off. In the same fashion, bills receivable, bills payable, loans E side, loans given, loans taken is supposed to be knocked off. Okay. Yes, that is the matter. So suppose sometime what happens, maybe your current account balance may not be tallying. Why is it not tallying? Because there may be cash in transit or goods in transit. So that's why who has not recorded the journal entry should identify and ensure that it is first the current account balances should match after passing this cash in transit or goods in transit journal entry. Once both the accounts are tallying, both the numbers are tallying, then you are supposed to knock off both the things. Okay, right. If there is an unrealized profit, yes, unrealized profit on what? Unrealized profit on sale of goods or sale of fixed assets. So it's a very simple thing. First you need to identify who sold to whom. Correct na? Suppose sir, subsidiary sold to parent company. Yeah, could be. Subsidiary sold to parent company means subsidiary made a profit. Yes. Correct na? Is that the goods are sold by the holding company to somebody? No sir, it is still with me. Okay, to the extent you have got this na. So whatever the profit made by the subsidiary, that is not correct, because you people holding and subsidiary company, one pocket to another pocket, goods are transferred and you are booking the profit, which is illogical. Correct? It should be eliminated. So how do you eliminate? Simple thing. Who made the profit? Subsidiary. Subsidiary profits are analyzed under which step? Step number 2. Correct now. Go to step number 2. Under the post acquisition profits, you reduce minus, correct na, unrealized profits. Correct, reduce karo. And same number you are supposed to reduce it. You are supposed to reduce it from where? From the inventory. Obviously you are supposed to reduce it. So end of the journal entry is going to be retained earnings of the subsidiary company account debit to inventory. You are supposed to do it. In the same fashion, if the goods are sold by the parent company, then who made the profit? Parent made the profit. Parent profits are analyzed under which step? Step number 5. So under step number 5, retained earnings, correct na, parent company profits. Then you should say minus unrealized profits, eliminate it, and the same amount is going to be reduced from the inventory in the consolidated balance sheet. Like that you are supposed to eliminate. Uniform accounting policies. What is this? Yes, when you are consolidating the financial statement, you should ensure that whatever the accounting policies of holding, that should remain same for the accounting policies of the subsidiary as well. Correct na? So if it is no sir, subsidiary has a different accounting policies. If they are following different policy, no problem. But when you want to consolidate na, what would have been the numbers? Suppose example inventory. So holding is following FIFO method. Subsidiary is following weighted average method. I cannot say standalone is wrong. Correct. But when you are consolidating, your inventory, entire inventory should be converted into FIFO. Then only that number only should be consolidated. That's why generally all these parent company, group companies, they will ensure that parent company accounting policy exactly copy paste subsidiary company also. Otherwise, you are suppose again you have to work out and to change this. It will take a lot of time and effort. Next concept, important concept, different reporting. Okay, different reporting dates. What is different reporting date? Holding is preparing the financial statements on 31st. Subsidiary is preparing on 31st December. Okay, this is 31st March and this is 31st December. So do you have a gap? Yes, there is a gap of how much? 3 months gap is there. So can we consolidate? No, actually what we'll say we should not consolidate. Then what should I do? Yes, you should ask the subsidiary to prepare as on 31st March financial statement. From 1st April to 31st March financial statements, you should prepare it. Then only should consolidate. Under some circumstance, what will happen? Sorry, this is a very small subsidiary, dabba subsidiary, correct na? Correct na? There is no big transactions. Under that circumstance, okay, we'll ensure okay, you can consolidate it. But it's not like first you consolidate it, but during the gap of 3 months, that is January, February, March month, May, are there any related party transactions? That is parent company and holding company transactions are there. Okay, any significant event, something has been taken, something like loss, huge loss, some fire accident, that loss, this loss, something has happened. Yes, you have to take care of those things in the financial statements. Even if you are consolidating 31st December, those things you are supposed to take place. And the standard says the gap between these two dates should not be more than 6 months. That is what one condition which is kept by the standard. Okay, consolidation P&L is which is very easy. Correct. Now I told you line by line consolidation. Total sales of holding company plus total sales of total sales of subsidiary company, that will be in the consolidated profit and loss. Same way total expenses also will take. Same way tax expenditure also will be taken. But we will eliminate. What do you eliminate? Suppose holding sold goods to subsidiary company. Then holding company sales may you are supposed to eliminate, and subsidiary company purchases may you have to eliminate, as if there is no such transaction happened. You are supposed to take care of this. Okay, right? Any expenditure, any interest income, interest expenditure, all these things should be eliminated. At the same time, current year, what is the subsidiary company profit? Out of this, and 100% is not related to the parent company. So out of the current year profits of pay subsidiary company, the 20% minority is there, that should be eliminated. Should be, I mean, it should be right, total profit minus, right, share of minority. You should give the 20 percentage of the subsidiary profits, correct, not the entire group profits. Subsidiary profits go, remove it, then the remaining amount will be taken to by the group company. Okay, like that you are supposed to determine and calculate. That's all about, my dear, accounting standard 21.
Let's get into accounting standard 23, accounting for investment in associates in the consolidated financial statements. Here the standard name itself is very clear. This standard is applicable only when you are preparing the consolidated financial statements. Okay, in the consolidated financial statements, how to present the investment in associate. Okay, even accounting standard 27 also, when you're preparing the consolidated financial statement, that means accounting standard 23, accounting standard 27 comes into the picture when you have accounting standard 21 also. Okay, but with respect to 23, there is one more point. Suppose, sir, I have only one associate. Are we supposed to prepare consolidated financial statements? We have to say that we are preparing consolidated financial statements, but here there is nothing like line by line consolidation. Equity method will be followed for investment in associate, and we'll say that means two numbers will change. What is the two number will change? Investment in associate, one number will change, reserves and surplus will change. Then we'll say this financial statements are consolidated financial statement. That's all. Okay, but anyhow, so what is, let's understand what is associate, what is equity method, all those things. What is an associate? Associate is an entity where the investor has got the significant influence. What do you mean by significant influence? I mean, we'll have the power to participate, correct? We will not be able to control, but we have the power to participate in the financial and operating policy decisions of the company. Okay, I mean, we will be, how do you say that is correct? How do you get this? We may get it by way of having a share, that is voting rights, or maybe via agreement, maybe because of the law. Okay, how do you say you have got significant influence? We can say the characteristics, maybe these are some examples of it. We should be having some representation in the board of directors, or you may be having significant material transactions, and correct na? And you may be able to appoint the CEO, CFO, or any other, I mean, governing body of the company. Correct? Maybe you may be having a right to do that job. Correct na? And you may be giving a potential and important technology which is required for the company, maybe with less percentage of stake, because you may not, you have the technology but you don't have the I mean, voting right exactly. Okay, all these things will give. Okay, if you have investment in associate, then that investment is supposed to, for the accounting of that investment, you are supposed to follow. Okay, you are supposed to follow, just a second. Yeah, you are supposed to follow equity method of accounting. What is equity method of accounting? Right, initially it will be initially when you purchase, correct na? Right, I mean, I forgot to tell one more sentence. Correct, when you say you have a significant influence, when we have a ownership to what extent is, that is 20% or above. Okay, if you have 20% or above, we will say that the other entity is an associate to me. Okay, sir, but if you have 20% is above, but if you don't have a power to participate in the financial and operating decisions, then we will go by the substance over form, not just because you have got 20%. Correct. Now, if you don't have the power to participate, you don't have the significant influence, then you are not supposed to follow this standard. Such kind of investment, sir, I have 30%, but I don't have power. Then follow accounting standard 13, my dear. Then don't come to accounting standard 23. Okay, right. At the same time, sir, I have got less than 20% stake, sir, but correct, but I have got the power to participate. Still, again, substance over form. Since you have got the power is important rather than the percentage. Okay, so you have got 15 percentage, but you have the power to participate. Still, you are supposed to follow accounting standard 23, not accounting standard 20. I mean, not the accounting standard 13. You have to follow 23 only. Okay, let's come to this this topic of equity method. Initially, you should measure your investment at cost. Okay, and not only measuring at cost, my dear. Okay, you have to determine what is the goodwill or capital reserve on the date of acquisition. How do you determine? That is nothing but what is your cost of investment minus proportionate share of the equity on the date of acquisition. Again, equity means like net assets. Okay, right now the point, there is one important point. Suppose you have got a goodwill, but goodwill cannot be recognized on acquisition of associate, my dear. That will not be recognized. That means it will not appear in the balance sheet. It may be given as a note inside, but not on the outer column. No, we do not show it. Correct. But if it is a capital reserve, that will be recognized. That will be part and parcel of your. Okay, that will be part and parcel of your what is that? Yes, your reserves and surplus will be taking care of it. Okay, carrying amount, correct na? Right. Subsequently, what will happen? Subsequently, if you have got any profits, subsequently, after the date of acquisition, if your associate had made profits, say 100 rupees, right? We have got 30% stake. Then what do? 30% of 100 rupees is equal to 30 rupees. To the extent of 30 rupees, I will take into my profit and loss statement. And correct na, there should be a journal entry, right? So that's why we'll say investment in associate account debit 30 rupees to our profit. Correct, income from associate. In the profit and loss statement, we'll show at one line item income from associates. Correct, na 30 rupees will show it. That means this side retained earnings, this side investment in associate. Correct, na these two will be increased. That's what, only one number on the asset side, one number in the equity is going to be changed. No other assets, other liabilities are going to be changed because of this equity method of accounting. Okay, and subsequently, if you get a dividend distribution from the associate company, what do? Then we will say, because earnings are already accounted for, if subsequently money comes, that is realization of money. That's why what do you say? Cash account debit to investment in equity, you are supposed to record it. Okay, cash account debit to investment. Yes, in this equity method, these are the some following important points which you need to consider. Suppose associate company has a cumulative preference share capital. What are you supposed to do? As I told in the accounting standard 21 also, if you have got a cumulative preference share capital, you have to provide for the preference dividend, whether or not it is declared by the associate company. After reducing the preference dividend, whatever is the amount available to equity shareholders, from there you are supposed to take your portion of your share of profit. Correct now, not before providing the cumulative preference share dividend. Okay, got it. Right. So where an associate presents, correct now, suppose associate company is preparing consolidated financial statement, associate company is preparing, correct now, maybe associate company has some subsidiary, that's why they're preparing consolidated financial statement. Right. So now I should take a profit from the standalone financial statements of associate or from the consolidated financial statements. Standard is very clear. You have to take the profit of the consolidated financial statements of the associate company. You should take it. Okay, next. Suppose sir, my associate company is making losses. Okay, yes. So then if you take loss, yes, you have to take your share of profit or share of loss. Both you are supposed to take it. If there is a profit, investment in associate account debit to profit and loss statement, or profit and loss account debit to investment in associate, like that you are supposed to do it. But when you make losses again and again, losses, but you can make maximum what? To the extent of investment account balance becomes zero. Correct. Now it cannot be beyond that. This is some important point which you need to keep it in mind. Step acquisition. Sometimes what happens? Okay, subsequent. Like say, what is that? You purchase like this take 20% acquired in. Maybe step acquisition. This is not in one go. It must have come in two times. I mean to say what? I have got end of the say first time I purchased 10%, next time I purchased 15%. But totally I have got 25. After purchasing the 15%, I have got what? I have got the power to participate. Significant influence has come. Correct. Now, what are you supposed to do? Yes, here also you are supposed to consider the calculate the goodwill or capital reserve. In this case, what do you do? When you have purchased for first time 20 percentage, no, that day how much was the correct? Now, that day how much was the 10 percentage of the net assets on the date of first 10 percentage. Again, 15% when you have acquired that day, how much percentage was the stake? Net assets ka 15% proportionate you are supposed to take it. Accordingly, you have to determine the goodwill or capital reserve. Right here, one more important point: unrealized profits or losses. I'll explain you little lightly, but for this, no, you unless until you solve a sum, otherwise it will not be so clear. Yeah, in one simple line, I can say unrealized profits, 100% profits and losses cannot be eliminated, but we will eliminate only our stake. Okay, that is investors' interest. Our suppose you have got 20 percentage of profits. Yes, 20%, I have the stake in associate. Yes. So here only like you listen the words of like upstream transaction, downstream transaction, whatever the transaction, to the extent of investors' interest will not be recognized. Okay, right. Our stake, our share 20 percentage will not be recognized in the because I'll be taking actually 20% of it. No, so that's what we will take it. Right. Next concept is different reporting. Correct. Now, different yes, different reporting periods. Yeah, actually, in this different reporting periods, no, standard does not say anything much. Actually, they don't keep the correct me. As I said in accounting standard 21, like 6 months gap should be there. But actually, as per this standard 23, there is no information about 6 months or 3 months, and no such information is given. But still, even though it is not mentioned, maximum 6 months you are supposed to consider that make will be making more appropriate decision. Okay, if the periods are two different periods are there, then yes, it's not a problem. You can consider the profits, but again, you are supposed to keep in mind any related party transaction or any significant event took place in the gap of January, February, March, that is supposed to be taken care. Okay, right. Again, uniform accounting policies. Here also you are supposed to ensure the uniform accounting policies. If my policy is not followed by the associate company, may not be following, but still you are supposed to make an adjustment to the financial statement so that the uniform accounting policies are followed. After adjustments only you should consider the profit, or you should consider the real profit or loss of this company, and from there only you are supposed to take your stake percentage of profit or loss. Discontinuation of equity method. When do you discontinue? When you stop following accounting standard 23. These are like same thing. When you have lost the significant influence, how you lost? Maybe I must have sold it. Correct na? Maybe correct na, I must have sold, like I have got 25 percentage. I sold 10 percentage, it became 15 percentage. Now I don't have power to participate. Then you should not follow accounting standard 23. Then what should I follow? Accounting standard 13 you should follow. Or I have got like in the Pakistan example I told you in accounting standard 21. You have got severe long-term restrictions, correct na, which is impairing the transfer of money. Correct, you are not able to get one paisa from the associate company. All right, under that circumstance also you are not supposed to apply this accounting standard 23. Under both the circumstances you are supposed to follow accounting standard 20 sorry accounting standard 13, investment accounting, long current or non-current investment you are supposed to follow. That's it about this standard, my dear. Let's start with accounting standard 27, that is financial reporting of interest in joint ventures. Okay, here also, right, first let me get into that one. First, what is a joint venture? That you need to understand. Correct na? Right, what is a joint venture? How many types of joint ventures, and when it will come to a consolidated financial statements, that matter is supposed to be discussed. What is a joint venture? Joint venture is nothing but an agreement between two or more parties, where both of them together. Both or two or more parties wanted to control an economic activity. See this here. They did not say an entity. They said an economic activity, which is subject to correct joint control. Yes. What activity? It may be a running activity. I'll tell you. These are all like three types. Okay. Again, joint control means what? Joint control in the sense, yeah, without any unanimous acceptance by all the parties, you will not be able to pass any resolution. That means you will not take You will not take any, like majority 50, above 50% rule will not be applicable. Unanimous acceptance or agreement by the venturers is mandatory to take any accounting, what is that, financial policies or operating related policies. You wanted to run the company means you have to take this unanimous consent. Okay, right. So joint venture versus subsidiary. This is something good. I mean, suppose example, it's a joint venture organization. Suppose I have got 60 percentage, other party has got 40 percentage, but we have got an agreement among us. I mean, between us. What is that? The agreement says that every resolution, even though I have got 60 percentage, we need a unanimous consent of both the parties. In this situation, am I supposed to, by having more than 50 percentage, I should follow accounting standard 21, or I should follow accounting standard 27 because I have got a joint venture? Okay, but what the standard says, right, if you have got more than 50% stake, so first you should follow only accounting standard 21, not accounting standard 27 is the answer from this standard. Okay, is it correct? Does it make sense? Maybe not making sense, but that is what the standard it says. Okay, next, what are the, right, I told you joint ventures of economic activity. That economic activity are joint, this the form of joint ventures can be three. That economic activities can be running into three. What is that? One is JCO, jointly controlled operation, jointly controlled asset, or jointly controlled entity. So consolidation comes into the picture under the third circumstance. First two circumstances, no consolidation, only standalone books of accounts would be more than sufficient. Okay. Now, if it is a jointly controlled operation, what will happen? See, some part, suppose you are supposed to make one item, correct now? Yes, I will say that I'll make the 50 percentage of work, you make the 50 percentage of work. Okay, you sell it to some party, whatever comes, from there 50 percentage we'll share it. It's an understanding between both of us, right? Now, what do? I will purchase my raw material, correct? You will purchase your raw material. I'll have my labor, you will have your labors, correct now? We'll use our machines, you use your machines. That's all. So already my machines and my assets and my salaries, my expenditure is sitting already in my books of account. Your expenses, your assets and your labor, everything is sitting in your books of account. Whatever the revenue comes out of that, 50% I will account as my income, 50% you will account as your income. So for this purpose, I cannot control, correct, I am not controlling your business, you are not controlling my business, correct now? I am controlling my business, you are controlling your business. That's all. So no consolidation will be incorporated. That's all. So no, separate accounting treatment as such is required. It's very simple. Even though there is an activity controlled by both of the parties together jointly as per the agreement, no new accounting will be required in this case. And second circumstance, it's a jointly controlled asset. Okay, what will happen? Suppose say there is a, correct now, there is one building. I will pay 60% of the money, you will pay 40% of the money. Correct now, let us rent it to somebody or let us do some work over here. Correct now. Whatever the money comes, no, in agreed percentage, we'll take our share. Correct now. Here in this case, it is a jointly controlled asset. So in this case, 60% is held by me. So I will write in my property, plant and equipment, right? Asset held by me 60 percentage. Suppose example total is equal to 1 crore. 60 lakh rupees I paid for you. Correct number. I paid for the same. So 60 lakh rupees only will be presented in my books of account. Correct. That's all. And the 40 lakh rupees will be recorded in the other company books of account. And if there is an income comes, that also will be taken in 60:40, whatever the ratio, if it is agreed upon. Correct. Now, that only will be recognized. That's all. No separate accounting. Here there is no separate legal entity that whether to consolidate or not. That question itself does not arise. And the last criteria, jointly controlled entity. What did you do? Myself and you, both of us, maybe 50-50 stake or 60-40 stake. Not 60-40 stake, 50-50 will say, because 60-40 means consolidation is going. That's the reason. Okay, so 50-50 stake, we opened one company. Okay, and the company is doing the business. Correct. The company has some assets. Company has liabilities. Company has some operations. So they are getting some profit. You're getting my point? They're getting some profit. So all this business is taking place over there. Correct. Now, under that circumstance, what are you supposed to do? You are supposed to consolidate. How do you consolidate? Are you controlling? No, accounting standard 21 is not applicable. How much is your stake? 50%. So the assets and liabilities, assets of that company, 50% of the assets will be taken by me. I mean, you will record it you'll do consolidation, line by line consolidation you are going to perform, which I am explaining here. Okay, so you are supposed to consolidate, correct? When you are consolidating the joint venture, you are supposed to follow proportionate consolidation method. What is it? I am going to explain it to you. Okay, proportionate consolidation method is supposed to be followed. What is this method? I told you now, the assets of the new jointly controlled entity, that is a venture we call, correct now. We are called we are called venturers. What is the company we opened? That is called venture. Okay, venture company balance sheet, you take it. Suppose there is a PPE of 1 lakh. Out of 1 lakh, I should take 50%. I have my PPE already. So my PPE is equal to, I mean, in the PPE of my financial statement, my PPE plus 50,000 rupees, I'll take it. And any other assets, cash also 50% of every line item, say 50 percentage will be taken into my profit and loss statement. And I have to eliminate my investment in the joint venture. Yes, you will be eliminating investment in your joint venture, and because of this you may be getting the goodwill or capital reserve. How do you calculate goodwill? Same like, correct, now what is your investment and the correct how much you invest, how much you paid for the on the date of investment, minus, suppose you have got 40%, 50% stake at the date of acquisition, what is the net assets of the company? 50% of it you are supposed to take it. Then the difference amount is going to be considered as goodwill or capital reserve. If it is a goodwill, goodwill will be recognized. It's a capital reserve, it will be recognized. Like accounting standard 21, how you show it, same way you are going to show it in the consolidated financial statements. Correct. Now, since I am recognizing only my 50 percentage, correct. Now, there won't be concept of minority interest. In the same fashion, correct now, like step number 5 of accounting standard 21 may what you do, same thing, correct. Now what is the profits of venture? Means my company profits I will take it, plus our share of post acquisition profits of the venture entity, correct. Now I'll take it. This total will be taken in the consolidated balance sheet. May I am going to take it into account. Okay, and again here also uniform accounting policies are required. Yes, here if you don't have uniform accounting policies, you are supposed to make necessary adjustments to the financial statements, and later only you are supposed to do the consolidation. Otherwise it won't give a correct picture actually, right? In case of different accounting periods, here also yes, same 6 months concept is there, correct now. Yes, if there is a gap between the venturer balance sheet date, venture balance sheet date is more than 6 months, you are not supposed to do the consolidation, correct now. If it is less than 6 months, it is acceptable, correct. Actually we should ask the other party to prepare as on the date of the venturer. If it is not practically possible and whatever the reason, then you can take it, but subject to some major important like related party material transactions. If something has taken place, then you have to adjust it. Then yes, then you follow the proportionate consolidation method, correct. If the transactions are happening between the venturer and venture, here also little bit similar, not exactly like accounting standard 23, correct. Now what are you supposed to do? Recognize only the portion of gain or loss related to other parties. If there are three parties, okay, I am holding only 40 percentage, other party is holding 60 percentage, we will take the 60 percentage voila, but not the 40 percentage. This is same with respect to the opposite also, in a different style exactly. Okay, right. So that's all my dear about accounting standard 27. Okay.